Joanne Simon, Councilmember Lincoln Ressler, and Councilwoman Shahana Hanif, who are also co-hosting this together. So thank you.
Thank you. Assembly Member Simon, do you want to say a few words?
Sure. Thank you so much. I'm Assemblymember Joanne Simon, and I'm really delighted to be able to help get the word out about the great work that the Community Service Society is doing. You know, when you're in government and you are funding organizations, you want to make sure you're funding those that are actually going to be doing the work and doing it well. And we couldn't be happier with the work that Community Service Society is doing. And they run this EdCap program, which is a terrific program. We know that student loan debt disproportionately affects women, you know, low-income populations, people of color, and really can suppress your ability to move forward with your education and join those careers that our workforce desperately needs. So this is an important webinar. As you know, the Supreme Court killed student loan debt forgiveness plan, and the government has come out with a new approach to do that. There are fewer people eligible, but many, many people are eligible. And I'm really glad to be part of this effort to help bring that information to the public. So I want to thank CSS again, thank Senator Gurnardez and Councilmember Ressler and Councilwoman Hanif for sponsoring this as well. Thank you.
Thank you so much. And obviously, thank you all for the support. Councilmember Ressler?
It's great to be with you. Good afternoon to everybody. This is my third event with Joanne today, so I'm having a really good day. Andrew, we missed you. But it's so important that we're together to discuss this topic, and I have the utmost admiration for the Community Service Society for forever. CSS has been there fighting for the most vulnerable, fighting for people's economic rights, connecting people to healthcare, doing what needs to be done to make sure that New York is a better place, and always centering people in that conversation. And you know, the president tried to do the right thing on student loan debt, and unfortunately, we have a less cooperative Supreme Court these days. They've, you know, as Joanne said, they have recalibrated, and there's still a lot of good opportunities that are available to people as we begin the process again of starting to pay back our student loans. And it's just so darn important that we understand the new rules and new regulations and take advantage of every single opportunity that's afforded to us around auto pay, around repayment plans, around benefits from work in public service and opportunities for loan forgiveness, and just understand the issue as thoroughly as we can so that student loans don't break us, because it's an extraordinary burden that too many people are facing. And with sharp guidance from CSS, we can help make it a little bit easier. So thank you to Carolina and Nancy and the CSS team for sharing your wisdom and expertise with all of us, and to Joanne and Andrew and Shahana for partnering to help get the word out and making this event, making this happen. If there's anything that me and my team can do to help, if you need any advice or any questions, just give our team a call. We're at your disposal, and look forward to a great session.
Thank you so much. Thank you all. So we're going to get started. I'm going to attempt to share my screen and hope that I don't freeze, because that happened earlier, but let's try this. If anything, my colleague Nancy will be ready to chime in and get us started. So Nancy, if you can confirm that you are seeing my screen.
Yes, we do see it.
And let me just do full view. Okay, so I am going to make your head hurt a little bit, but there's really good news. And the good news is that we offer one-on-one counseling services. So you basically get assigned a student loan counselor that is able to hold a session, review your specific loan times, have a conversation with you regarding your short-term and long-term plans, and then we help you develop a plan and execute it. So don't worry, you have access to us in case this is just the lot and you really need that one-on-one. Here's the agenda. I'm going to talk a little bit about EdCap. We're going to talk about what happens next after the Biden inheritance Harris student loan cancellation was struck down by the Supreme Court. I'm going to go over key dates, and then we're going to focus a lot on what are some key strategies that you should be thinking about. We're also going to be talking about your repayment checklist, the things that you must do if you haven't already to prepare for when payments resume next month. And then we're going to talk about those loan forgiveness options and allocate some time to discuss the new repayment plan known as SAVE, which actually has really amazing features. So here's our contact information. Everyone who registered for this webinar is going to get a copy of our PowerPoint and a recording in case you need to go back. Again, Community Service Society, nonprofit organization, all of our services are free. We are funded by New York State, and we really appreciate the support. Our website is there as well. So what do? We basically help student loan borrowers with any issue related to both federal or private student loan debt, or even direct to school debt. So whenever you think of a higher education debt issue, you should think about EdCap, because chances are we are able to help you figure out and resolve your problem. Short from having all the money in the world to pay off student loans, we can help you access any forgiveness and relief available to you. So last year we got funding to provide services around the state, and we now have 10 community-based organizations that are providing the same services in their respective communities. We at Community Service Society operate our helpline and also provide the one-on-one counseling sessions. Most of our sessions are still remote, but if people need the one-on-one, we can figure out who best to refer them within our network. So again, we do everything related to helping people get out of default, select their best repayment plan option, figure out if they need to consolidate their loans to benefit from loan forgiveness, access those loan forgiveness discharge programs, and whenever necessary, refer out to other agencies or referrals based on the specific needs of our client. So
Carolina, before you go on, can I just mention to everybody, if you have any questions during the presentation, feel free to write them into the Q&A. I'll be monitoring the Q&A questions throughout the presentation, and Carolina will periodically stop so that we can share some of that information with the rest of you.
Thank you, Nancy. I forgot that detail. So Nancy is an expert. Type in your questions, whether it's related to anything I'm covering, and she'll be able to answer them throughout the presentation. So as I mentioned, Biden and Harris 10 up to 20,000 cancellation plan got struck down by the Supreme Court, and that was obviously devastating because it was broad-based. However, the Biden administration is really committed to helping as many borrowers, and we recognize that that Supreme Court decision did not have an impact on the rest of the relief currently available. The government is trying to implement even more flexible rules. So it didn't have an impact on income-driven repayment forgiveness, public service loan forgiveness, total permanent disability discharge, and other programs that I'm going to talk about that you may be able to access right now. So here are some key dates to know. The new repayment plan known as SAVE, and I'm going to go more into this repayment plan, became officially available at the end of August, and people can currently enroll through studentaid.gov. Again, I'm going to go into the ins and outs of that plan later on, but it is now available, and that's going to lower the monthly required payment for a lot of people. As of September 1st, interest started to accrue on federal student loans that were subject to the payment pause due to COVID. Your first payment is not going to be due until October. I'll give you more details on that. December 31st is actually a critical deadline that a lot of people are not aware of. If you want to take advantage of the more flexible rules for eventual forgiveness within 20 to 25 years, you would need to make sure you have the right type of loans by December 31st, which I'm also going to talk about to make sure you don't miss out on that. In 2024, the IDR account adjustment, which is a particular one-time program the government is implementing, is going to have kind of an outcome. In other words, all borrowers are going to know where they stand in terms of the 20 to 25 forgiveness track. And then late in 2024, that will be the end of a program for defaulted borrowers called Fresh Start, meaning people who have loans in default should take advantage of this program in the upcoming year because it's going to end. And I'll talk more about Fresh Start. Before we move on into the more details aspects of payment resumption, I want to point out that the federal government acknowledges that it's going to be a tough situation to make sure that 44 million borrowers enter repayment. So they are having a 12-month on-ramp program where basically people are going to have 12 months to begin repaying, meaning the loans are not going to be reported to the credit bureaus if you don't start paying in October, and your loans are not going to go into delinquency or default. However, if you are pursuing a forgiveness program like public service loan forgiveness or income-driven repayment forgiveness, it is in your best interest to enroll in a repayment plan, in an income-driven repayment plan, to make sure you get credit. If you simply don't pay, know that your credit is not going to be harmed. You're not going to be reported to the credit bureaus, but you're also not going to be working towards some type of forgiveness. So be aware of that, and give me just 1 second. I apparently need to make my colleague co-host so she can actually type answers. Okay, great. Moving on. So one of the common mistakes we see a lot of borrowers make, and it's not necessarily their fault, is not have a strategy. And a lot of people think, well, my strategy should be to repay these loans. Not necessarily. The levels of student debt we are seeing means they're relatively high, to the point where people could spend their entire career trying to pay back those loans and they may not be able to. The highest loan balances we have seen are $500,000, so $500,000. This could be individuals who had debt for their own education and Parent Plus loans. So if you have 3 kids, think about $100,000 each in Parent Plus loans plus your own debt. So it's not unheard of that we see people with several hundreds of dollars in student debt. So sometimes the strategy may not be to repay aggressively your debt. So there are 3 common strategies we usually discuss with clients, and you want to have a sense which strategy you may be pursuing, because that's going to, 1, give you peace of mind that you have a strategy, and 2, make the most out of the situation and manage your debt effectively, right? So the first strategy is kind of like the most basic common sense, and that is pay your loans as quickly as possible. Well, this is not going to be possible for a lot of people, but if your loan balance is low or manageable given your income situation, then the way to think about your student loan debt is like credit card debt. The sooner you pay it off, the more you're going to save in interest. Now, for most borrowers who have federal student loans, your interest should be fixed and it should be reasonable. It's not like credit card debt, but you know, some loans can have 6-7% interest rate. So again, keep that in mind, that the sooner you pay it off, the more you're potentially going to save in interest, and you're going to be done with your student loan debt. Now, if you only have undergrad, I feel that this may be an option for you. Again, it's all going to depend on whether you have a job and what you're earning. If you have a large loan balance because you went to grad school, then we may look at the second option, which is pay the minimum required and pursue a forgiveness program. I'm going to talk about those forgiveness programs. Forgiveness discharge means the same thing. You are getting rid of your remaining loan balance through one of the federal options available. In this case, your goal is to get the most amount forgiven, so you're just going to make the minimum required payment. Minimum required payment usually means that you're enrolled in an income-driven repayment plan in order to be eligible. That is to be eligible for public service loan forgiveness and income-driven repayment forgiveness. If you're pursuing a discharge program like bar defense to repayment, total and permanent disability discharge, then the repayment plan is not going to be a big factor. But again, for other programs, you may need to enroll in an income-driven repayment plan, right? So that's the second strategy. Well, if the first one and second one does not work, then the third strategy, which I know it's not like the best one that we think about, is keep your loans in good standing, enroll in the most affordable repayment plan until the end of time, meaning federal student loans are dischargeable upon death. and the government is not going to go after your estate. Now, usually we're having to discuss this as a strategy with older borrowers. We do have clients that are in retirement or near retirement or in their 60s and sometimes 80s. And to pay back the student loan aggressively, it would require them 20, 30 years. Well, realistically speaking, by that time, they may no longer be here. So their strategy is just keep their loans in good standing until the end of time. I'm going to pause there to see if there's any questions right now, Nancy, and before moving on to the next.
There are no questions. And just a reminder, if you do have any questions about anything that Carolina is speaking about or any other subjects on your mind regarding student loans, please type them into the Q&A and I'll be happy to answer them.
Great, thank you. Okay, moving right along. Here's your student loan repayment checklist. So we just went over some strategies. I want you to start thinking about them. You can let the information sink in after this training, and you can follow up with us if you want to really hone in on one of those strategies or review them all. Here's your student loan repayment checklist. Here's an overview of what I'm going to discuss. I'm just going to dive right in to make sure that we cover everything. If you haven't already, you want to make sure you have access to studenta.gov. Studenta.gov is the same website you use to apply for FAFSA, financial aid, right? Every borrower has an account with studenta.gov. Whether you have access to it or not is a different question, but you technically have an account. If you forgot your username and password, you can go ahead and reset it. If you feel you've never created an account, you can go ahead and create an account. If you have created an account, they'll let you know that you actually have an account. Gain access to studenta.gov and update your contact information there. This is the federal government's national student loan database, and all your federal student loan information is going to be here. Whether you have Perkins loans with an institution or you have newer loans, it's going to be here. So you want to make sure you update your contact information so you don't miss out on any important notices. Now, the other reason why you want to get access to studenta.gov and become familiar with the website is because the federal government in the near future is going to transition fully to this website. So in the future, you will be using this as a portal to manage your loans. You will no longer be using a separate website with your student loan servicer. It will just be through here. We're not there yet, but it's important for you to have access to this website and become familiar with it. Now, once you're at studenta.gov, if you don't know this information, you want to locate your student loan servicer. Your student loan servicer is not your lender. The federal government, the Department of Education is your lender if you have federal student loans. Your servicer is contracted by the Department of Education to basically invoice you and manage your loans, kind of the daily operations, and help you enroll in a repayment plan, right? But they are not your lender. About 40% of student loan borrowers had a servicer change in the last 3 years and a half. So chances are, flip a coin, you probably had a servicer change. Go to studenta.gov. On the homepage on the right-hand corner, you're going to see who your student loan servicer is. If you haven't already, create an account with your student loan servicer. They are the ones that are going to be sending you your invoice. They're going to send you an invoice at least 21 days before your payment is due, which I'm going to cover in the next slide. But again, you want to make sure you have access to your student loan servicer, update your account information with them because they're going to be sending you critical information like now. So don't miss out on that. You can read on the servicer changes there. If you have any issues, you can always call FSA Information Center to find out who your servicer is and all that good stuff. Now, enrolled in the right repayment plan. We can spend an entire day going over the ins and outs of the different repayment plan options. I want you to just think about 2 categories of repayment plans. The first category is called income-driven repayment plan. Income-driven is just the umbrella term, and there are 4 plans within income-driven. Revised pay as you earn, which is now SAFE, the latest repayment plan. Pay as you earn, income-based repayment, which sounds very familiar, like income-driven, and income-contingent repayment. You want to be familiar with those terms because if you're opting to enroll in an income-driven repayment plan, you're going to be enrolling in one of those. The reason why you would enroll in an income-driven repayment plan is if you're pursuing public service loan forgiveness or a program called income-driven repayment forgiveness. It says that after 20 to 25 years of you being enrolled in one of these plans, your remaining loan balance gets forgiven. And I know that 20 to 25 year may seem like a mighty long time, but you may be surprised how many clients we see that are at the 20-25 year period or close by, and they will have their repayment, their remaining loan balance forgiven. The con about an income-driven repayment plan is that you have to renew every year, although I have some good news to share later on. The other category of repayment plans, it's traditional plans. Those are not based on your income. Those are based on your remaining loan balance, a predetermined payback period, and your interest rate. They do not have eventual forgiveness attached. So there's no forgiveness with traditional plans. The reason why some clients may end up in a traditional plan is because their income may be high relative to their loan balance, and they cannot afford an income-driven repayment plan. And a long-term extended traditional plan may be better or more affordable. So again, two broad buckets of categories. I will be going into the SAFE plan because I think that's the more generous repayment plan. So here we are with SAFE. So the federal government came out again with this new repayment plan. Initially, we thought they were not going to be implementing it until next year. But given the Supreme Court decision, the Biden administration said we're fast tracking it. So phase one of this plan went into effect like now, as of last month. So the big benefit of this plan is that people are going to pay less on their monthly payment because the amount of money that gets disregarded in the payment calculation increased from 150% of the federal poverty level to 225% of the federal poverty level. So that's a benefit that you can take advantage now. There's going to be a phase two, and it's going to impact more people who have only undergrad loans. So if you have undergrad loans next year, July 1st of next year, your required payment would be 5% of your discretionary income versus 10% that it is right now. If you have a combination of both undergrad and grad, it would be a weighted average. If you have only grad loans, next year you would still pay 10% of discretionary income. Overall, it's a big benefit just by the new formula that they're using. What does this mean? This means that if currently, for example, for a single individual, you make less than $32,000, your required payment is going to be zero. If you make more, then you will pay more, right? And based on your income, you're going to be paying a specific amount. Overall, we're seeing life-changing events for clients who before couldn't even afford the lowest repayment, income-driven repayment plan option. So be aware of this. Now, if you only have Parent Plus loans, or if you have Parent Plus loans, know that those Parent Plus loans are not eligible for this new plan, which is really unfortunate. And it's something we're going to continue to advocate for because we're seeing a lot of Parent Plus loan borrowers in distress. Now, for Parent Plus loans, the only income-driven repayment plan available is the income contingent repayment plan, and you must consolidate your direct Parent Plus loan. Bottom line, if you have Parent Plus loans, I really encourage you to reach out to us because we really need to have a one-on-one conversation to figure out how we're going to tackle this set. How do you enroll in the SAFE plan? You can do it right now through studentaid.gov. You're going to go to loan repayment, and then you're going to select income-driven repayment. The application can take 15 minutes. There are some new features on this application where you can opt to get auto-enrolled and auto-renew into the plan, meaning if you're enrolled in an income-driven repayment plan, not only SAFE, which I'm going to talk about those features, you can authorize for auto-renewal, and the government is going to cross-reference your tax returns and all that good stuff. If you are married, know that if you file jointly, they will consider your spouse's income for purposes of determining your repayment plan. If you don't want your spouse's income to be considered, you would then have to file separately. Okay, if I've already covered the Parent Plus loan issue, again, you can enroll in SAFE. Now, if you were enrolled in Revised Pay As You Earn, Repayee, you should have already been transitioned to SAFE. If you have any issues, reach out. We can help you figure out what is wrong. Which repayment plan is best for you? Well, every situation is going to be different. Here are some general guidelines. The SAFE plan is probably going to be the best option for a lot of borrowers. All you need to do is have direct loans. If you don't have direct loans, you could consolidate them through studentaid.gov to make them eligible. Again, with the exception of Parent Plus loans, they're not going to be eligible for SAFE. All other direct loan holders should be eligible. If you have non-direct loans like Belp and Perkins or Heal, now is the time to consolidate them, not only to make them eligible for the SAFE plan, but also to make them eligible for other forgiveness options that we're going to talk about. Again, big takeaway, the only income-driven repayment plan available for Parent Plus loan borrowers is the income contingent repayment after you consolidate those Parent Plus loans. Here's the automatic recertification that I was talking about that I got a little bit ahead of myself. All income-driven repayment plans have to be renewed every year, and it's based on your renewal date. So if you enroll right now or you renew right now in September, next year around this time, you would have to renew it. Again, the new application allows you to authorize the government to do a data match with your income taxes. If you're a 1099 employee or you're not your traditional employee or you don't file consistently your taxes, they may not be able to do a data match, so you might manually have to renew. But know that that is now an option for a lot of borrowers, which is life-changing because a lot of people would fall out of a plan because they forgot to renew. So you have to recalculate your monthly payment every year, again, because it is based on your household income, modified adjusted gross income, and household size. Okay, I hope that is useful. Now, when are you going to get your first invoice? I want to say that in the next few days, you should be getting your first invoice because your first payment is going to be due next month. Servicers are legally required to send you that invoice at least 21 days before your first payment is due. Not everyone's payment is going to be due October 1st. You each are going to have your own due date. If you graduated during COVID, pay attention to your correspondence because they're going to let you know what is your due date and what is your amount. If you were paying prior to COVID, you can expect that you're going to get around the same due date. If that due date doesn't work for you, you can call your servicer and change the due date within the same month, right? So be aware of that. Make sure that you know you could do that if, let's say, the first is not working for you, you need an extra paycheck to cover this. Be ready to make monthly payments, and I am not saying that like everyone is going to be ready. If you have issues, reach out. Let's have a conversation of what may work best for you if you're going to be struggling with those payments when they resume. In general, if you want to do auto debit, there is a benefit of an interest rate reduction. It's a small one, but it's worth it. You could enroll in auto debit through your student loan servicer. Do it right now if you haven't, because it does take at least a cycle or a couple of weeks for that system to be ready to go and for payments to be deducted from your account come October. Auto debit is optional, but again, for some people, it may work well and you still get that subsidy. As a reminder, if you're not ready to pay in October for whatever reason, you should not have an adverse impact on your student loans. The government is giving folks 12 months to get back on track, and they're not going to be reporting to the credit bureaus any delinquencies or sending the loans into delinquency or default. What if things go wrong? There are ways you can escalate. You can file a complaint with the FSA Ombudsman, CFPP, and here in New York State, the Department of Financial Services actually oversees federal student loan servicers. So if you're getting wrong information, wrong repayment plan, if you're having to wait hours on the phone to reach your servicer, which we've heard a lot of complaints, please, it takes 15 minutes for you to file a complaint online. It's basic information, what happened, what's the solution you're looking for. And it's really important that you report that because the government is going to be tracking issues and we need more people to report them to make sure that we have systemic change and the government knows about all the hurdles people are facing. If you need help filing a complaint, you can always reach out to us and we can help you with that. I'm going to stop there and turn over to Nancy before I continue.
So yeah, there have been a few questions, some important questions that I'd like to address. There was a question regarding the SAVE plan and whether or not you should recertify or recalculate that plan now if you were already enrolled in the revised pay-as-you-earn plan. So Let me just mention that when payments resume next month, the payment, if you were already in an IDR plan, the payment is going to be based on the income that was reported the last time you calculated or submitted an IDR application. So if you haven't submitted that IDR application in like 3 years and your income was a lot lower the last time you did that, then your payment is going to resume based on that lower income, assuming that and if your income is much higher now, you probably want to wait to recertify or recalculate that payment until you're required to do so, which won't be until sometime next year. So it really kind of depends on your situation. If you were already in the revised pay-as-you-earn plan and it's based on an old income, you'll be transitioned automatically to the SAVE plan, but it's going to be based on that income that you reported the last time you filed that IDR application. Now, if your income is a lot lower right now than it was the last time you filed an IDR application, now's the time that you would want to recalculate the plan or even switch plans if you want to be in the SAVE plan and you're not already in it. And of course, this is something if you're not quite sure to do, because I know that this confuses a lot of people, you should definitely reach out to us and we can help you walk you through that process. We had another sort of big picture question about broad-based cancellation and how that would impact the economy. And of course, you know, if all student debt was forgiven, it should have a relatively positive effect on the economy. But I think what I want to convey to you is that complete student loan cancellation is just probably not a reality, certainly not at this juncture. So we really want people to be aware of the fact, though, that there are a lot of options, as you can now see, as we're more than halfway through this presentation, that were not affected by the Supreme Court decision, that people can concentrate on and avail themselves of to help them either lower their payments or get them closer to eliminating your debt. And we think it's more important right now to focus on what's available because there is quite a bit. And then there was a question about how the discretionary income is calculated for the purposes of the income-driven repayment plans. This is kind of a technical question, but there is the basic formula for calculating income-driven repayment plans involves a percentage of your income that is protected from any payment. It's expressed as a percentage of the federal poverty level for a family of your size. The more income that is protected from any payment, the lower the payment is to you. And one of the things that the new SAVE plan does is it increased the percentage of income that is protected from any payment at all, which is why the payments are a little bit lower. So I think we'll just leave it at that right now. And
yeah,
that's it.
Like a couple more thoughts. I'll try to address the policy issue. Like, my heart breaks that I see so many people not be able to fulfill the dream of upper economic mobility because of this debt. And if nothing else, COVID showed us what that potential is. The number of new homeowners that were able to finally buy a house because they didn't have to pay their student loans was so meaningful. And so there is evidence in terms of the impact. As Nancy mentioned, our message right this moment is like, let's focus and try to get as many people to explore their options and get forgiveness through other programs. But I just hope that, you know, from a policy perspective down the line, and hopefully not in like too distant future, there's meaningful reform, because it does have an impact. If you owe student loan debt, you're going to be behind 10 years from what you were supposed to be able to accomplish from a financial wealth standpoint. So that's very meaningful. I do want to point out something that I don't have in the presentation, but maybe I should include. This is, the question is there someone who shouldn't switch over to SAVE? And there's one group of people that might think about it twice, but it's very specific. If you're enrolled or you're eligible for the pay-as-you-earn, you have graduate loans, and you're counting on getting forgiveness, eventual forgiveness, not public service loan forgiveness or other programs, you may want to stay in the pay-as-you-earn, because you can get your remaining loan balance forgiven after 20 years, even if you have grant loans, versus SAVE, it's 25 years. Again, It applies to a small segment of the population. Arguably, you have to be eligible for pay as you earn. You have to have grad loans, and you must be pursuing the 20-year forgiveness option for you to, quote unquote, potentially be better off in pay versus save. If you're confused, reach out. We can help you out. Okay, I'm going to move on because I think a lot of people are interested in this part, and I'm very mindful on time. I will get you out on time. Exploring forgiveness, cancellation, and discharge option. As I mentioned, forgiveness, cancellation, discharge, they all mean the same thing. At the end of the day, they're getting rid of your remaining loan balance and setting you free from student loan debt. So these are the top programs that I feel everyone should know. The first one, income-driven repayment forgiveness. This is kind of like a backup plan. If life happens, if your loan balance is too high, then your goal is eventual forgiveness. Now, in order to be eligible for what we will call eventual forgiveness, also known as income-driven repayment forgiveness, you have to be enrolled in and repay your student loans through an income-driven repayment plan. One of those 4 plans, right? Like SAVE, PAYE, IBR, ICR. Now, the only challenge that we sometimes see, and we hope we don't see as often now with the SAVE plan, is that an income-driven repayment plan may still be a lot for some people, right? But if you can enroll in an income-driven repayment plan and then know that within 20 to 25 years, your remaining loan balance is going to be forgiven. The general rule under the SAVE plan is it's 20 years for undergrad loans, 25 years for grad loans. But if your loan balance was less than 12,000 or 12,000 under SAVE, you can have your remaining loan balance forgiven after 10 years, and you can add $1,000 more in 1 more year for any above the 12,000. So if you borrow originally dispersed 14,000, you can have your remaining loan balance forgiven within 14 years and all that. All this to say, I just said a lot there. If your loan balance is high and you want a default option, this is your default option. Income-driven repayment forgiveness. The best news is the government is going to be giving a lot of people credit, even if in the past they were not enrolled in IDR, which I'm going to talk about. The next one is public service loan forgiveness, and this is a winning program right now. A lot of reform, a lot of changes went into effect last year. If you work for a government nonprofit, you can have your loans forgiven after 10 years. Any forgiven amount is not taxable, which is great. And there's a process. You have to submit a public service loan forgiveness employment certification form. That's one form that you use for every employer you've had. You can get retroactive credit. I'm going to talk about what you need to do to make sure you qualify for this program if you're not on track for that. Again, best way to get rid of high loan balances within 10 years. Borrower defense to repayment. If you went to a school and you feel you were defrauded, and it's fraud, it's not like I didn't like the program, I didn't like teachers, that's not going to cut it. If you were defrauded, you can apply online through studentaid.gov. It's called borrower defense to repayment, which basically says, hey, federal government, I was defrauded by this school that you basically approved to get financial aid, and I should not be liable for that debt. It's only going to take care of the loans you took out for that institution you're alleging fraud. It does take a while for you to hear back on your borrower defense to repayment claim, but after a few months, I think 6 months, you don't accumulate interest as you're waiting a decision. So it's a good program. You should check it out if you went to a school that, again, you feel defrauded you. Total and permanent disability discharge is probably more relevant to older individuals and definitely to individuals who are who have a disability. Now, the title of the program seems a little intense, total and permanently disabled, but it's not as intense as in the requirements. You do have to have a disability. It does not have to be certified by Social Security. You do not need to be getting Social Security disability benefits. You can certify your disability through a physician certification form. It's a simple application. Nelnet is the student loan servicer managing that program. At the end of the presentation, you're going to have links to this program. You can find out through this program whether your loans are dischargeable for this reason within like 2 to 3 months. which is record time given all the other programs and how long it takes. So the IDR account adjustment is related to both public service loan forgiveness and the income-driven repayment forgiveness program, the 20 to 25 years. The federal government acknowledged that a lot of the student loan servicers were steering borrowers into forbearances versus letting them know of the benefits of enrolling in an income-driven repayment plan. As a result, the federal government is saying for a one-time only, and all the programs have the one-time wording, we're going to give people retroactive credit. So basically, a lot of federal student loan borrowers are going to get credit from the time their loans enter repayment up until now, as long as they had some specific situations, meaning they were in repayment, not in default, not in in-school deferment. You're going to get credit towards the 20 to 25 years, even if you were not enrolled in an income-driven repayment plan. Now, if you want to make sure that you're on track for eventual forgiveness under income-driven repayment, you want to make sure you're enrolled in an income-driven repayment plan moving forward if you're not done with the 20 to 25 years. This program also has an impact on public service loan forgiveness because similarly, the federal government is saying, as long as you can show me you were working full-time for a qualifying employer, whether you were in an IDR plan, whether you paid on time or not, as long as you were not in default, we're going to give you credit. And there's an exception for the default status. We're going to give you credit. So we are seeing a lot more borrowers who have been working in public service get forgiveness because they're getting this extra credit, even if they were not enrolled in the right repayment plan, and even if they didn't have direct loans. You do need to consolidate direct loans. So here we go. If you are pursuing public service loan forgiveness, this is your checklist. You want to make sure that all your loans are direct. If they're not direct, you need to consolidate them via studentaid.gov by December 31st. Do it now. You don't want to wait till December. You then want to file the public service loan forgiveness employment certification form. There's more information on our website about PSLF and this form, and you can find it all over the place. That is the way for you to know that your employer qualifies, former and current employer qualifies, and how many months you have towards the 120 that you need to achieve loan forgiveness under PSLF. You want to make sure you're enrolled in an income-driven repayment plan. For a lot of borrowers, the SAFE plan may be their best option, except for Parent Plus loans, which again, ICR would be the only repayment plan if they consolidate their loans. And then you just want to track your progress. Your loans do end up with Mohila because that's the student loan servicer that manages the program, and they have a payment tracker. And then it's countdown, right? You're just tracking that you have qualifying payments. You submit the PSLF employment certification form every year to update your payment count. And then eventually you reach the 120 and you get forgiveness. If you are looking for the 20 to 25 year forgiveness, also known as income-driven repayment forgiveness or IDRF for short, same thing. You want to make sure you have direct loans. If not, consolidate them by December 31st. Make sure you're enrolled in an income-driven repayment plan, SAFE being probably the most favorable. And sometime next year, the federal government is going to come back to you and say, you have X number of qualifying payments for IDRF. And at that point, you can make a judgment call on whether to finish the program. To finish the program, you just have to stay enrolled in an income-driven repayment plan. And I am very hopeful that a lot of more borrowers will have an insight when that happens. It's going to happen in 2024. I'm not going to say early 24. It's probably going to be mid to late 2024 when you're going to find out what is your progress towards IDRF. Other forgiveness options and cancellation and discharge programs that I'm not going to go over. If you recently graduated in the last 2 years from a New York State school and you're working in New York State, you might want to look into New York State, get on your feet, loan forgiveness program. New York State will basically pay for 2 years of your income-driven repayment plan, which is great. I think it could benefit some of you. Again, you must be a recent grad and there's income requirements. You can get more information at HESC. There's teacher loan forgiveness. The caveat there, if you're pursuing both PSLF and teacher loan forgiveness, you cannot double count the time. So be aware if you have a high loan balance, you might be better off if you're a teacher to pursue public service loan forgiveness versus teacher loan forgiveness. School closure discharge, if you school close, you may be able to get your loans forgiven. Bankruptcy, really hard still to do, but it's still an option for borrowers. We do have a partnership, and part of our network is the City Bar Justice Bankruptcy Project. If you ever need a consultation about discharging your student loans through bankruptcy, let us know. We can connect you with them. And then as a reminder, your federal student loans are dischargeable upon death. Moving on, if your loans are in default, there is good news. You can get them out of default through an initiative called Fresh Start. You can do that by calling the debt collector. For most borrowers who have federal student loans in default, it's going to be the default resolution group. It's the 800 number. If you're going back to school, you could automatically get your defaulted loans into good standing by just applying for financial aid. This program is going to run through next year, probably all the way through August of next year. We're waiting for confirmation on the exact date of when it's going to end. The benefit of getting your loans out of default is that, again, it's going to bring them back in good standing, and you can then pursue a forgiveness program versus having them in default and risking garnishments and Social Security retirement offsets and all the bad stuff that comes with having loans in default. If you need help, if you have your loans in default, reach out to us and we're able to help you out. Here's your contact information, and I'm amazed that we still have 10 minutes for Q&A. I provided a lot of information. Reach out to us. There's our helpline number or email. We are quite busy right now for obvious reasons, but we will get to you. If we're unable to get back to you within the next 2 weeks before payments resume, don't worry. Again, the federal government is going to be having some flexibility for the first 12 months, and we can help you get back on track as soon as possible. Nancy, I'm going to stop there and see if there's more questions.
Yeah, so there were a couple of additional questions that I wanted to address. One of them was, this is a sort of general question. Is it better to try to pay off your loans quickly or to wait to see if the IDR plan will come through? So that's a question that can be very specific to an individual, but general rules of thumb, just because you're eligible for a forgiveness program doesn't always mean it's the right option for you. If you have a very high loan balance, particularly compared to your income, so your balance is high, but your income is sort of low to moderate income, you may not be able to even afford the payments in the traditional plans. And there may be no realistic expectation that you can actually pay that loan off in the traditional manner. In that case, pursuing one of the forgiveness programs is going to be probably your only option. But if you're in the opposite situation where your income is very high or high compared to your loan balance, you may be able to you may have the option. So in other words, public service loan forgiveness may still save you some money, but if you're just starting out and you know you have to pay for 10 years and you don't want to pay for 10 years and you can afford to pay the loan off quicker, you may choose to do that. So you have that option. You're really not married to a strategy. But again, that's kind of something that's very specific to the individual. If you want some help sort of sussing that out, you can call us. The other question that I did want to mention, sort of share with everybody is loan forgiveness more related to time to pay rather than decreasing amount? So this is actually an important point to highlight the way the loan forgiveness programs work. So with most of the student loan forgiveness programs, the big ones being IDR forgiveness and public service loan forgiveness, it's an all or nothing proposition. Once you meet the requirements, whatever the requirements are, if it's 10 years of qualifying payments for PSLF or 20 or 25 years of qualifying payments in IDRF, your entire balance is forgiven. Until that point, you actually don't get any forgiveness. So it's not a progressive forgiveness where you see your balances go down every year because you're meeting requirements. And by the way, this is something that the advocate community continues to suggest. So that there is sort of, you do get to realize some loan forgiveness as you go forward, but that's not how the big programs work right now. So you have to meet all the requirements of the program, after which your entire balances are forgiven. But don't be deterred. So if you're pursuing public service loan forgiveness, you need 120 qualifying payments, but you only have 60 or 50. Once you know how much progress you've made and how much longer you have to go, just keep meeting the requirements every month towards the program, and you'll continue to accumulate credit and get your balances forgiven.
And there's one more question that came up with it, which is a really good question. And then I want to come back to the SAFE plan about a couple of features that I feel like are important to highlight or mention, because I think I might have forgotten to mention. So one of the questions that came up, which I think it's really important, is for the 12-month kind of grace period the government is giving, do you need to do anything? As far as we know today, there's nothing you would need to do. Now, be aware, if you call your student loan servicer and ask for a forbearance, they will place you into a forbearance and you might be using your forbearance. So technically, every loan has a set limit of forbearance, like certain months that you can ask for a forbearance where you don't have to pay. You probably don't want to use that because the government is just simply not going to do anything with your loans, meaning they're not going to go into delinquency or default. You will still be invoiced, and the level of like emails or like make a payment now, we don't know yet, right? Like we're going to see it probably in November, December to see how that plays out. But again, as of today, we don't know of any application. Like the government is just going to automatically do it where they won't be putting the loans into delinquency or default. Going back to the SAFE plan, and I want to keep time in mind, there's a lot of confusion about the SAFE plan, and I think the SAFE plan does have the 20-year forgiveness option if you repay your loans for 20 years for undergrad, 25 for grad. Now, whether you decide to pay your loans off, it's going to be a math. The math really is, and again, every situation is different, based on your required repayment plan now and in the future, because your income is going to grow a little bit. Do a hypothetical. Are you going to be done repaying your undergrad loans? Let's stay with undergrad before 20 years. And if the answer is yes, then you're probably never going to reach income-driven repayment forgiveness. Now, regardless of the repayment plan you're enrolled in, your strategy has to be set, right? Like, so enroll in a repayment plan that you can afford. If you want to go the SAFE route and it works for you, the SAFE plan or an income-driven repayment plan is probably a good option. But have your strategy on the side. If your required payment is $100 and you're like, that's totally comfortable, I can actually give $300 per month, then your repayment strategy should be, for example, in that case, assuming it's a low balance, I'm going to repay them, pay them off as fast as possible. I'm going to stay enrolled in the $100 per month required payment, but I'm going to do lump sum payments. Every extra money I get, I'm going to pay it off because that's my strategy, right? Like my strategy is to pay it off versus my strategy is to get forgiveness in 20 years, 25 years for grad loans, or get forgiveness through public service loan forgiveness, or get forgiveness or discharge to total and permanent disability discharge. So regardless of the repayment plan, just have your strategy on the side and then figure out how best to implement it. Last, the SAFE plan has an interest subsidy, but it doesn't mean that you're not accruing interest on your loans. What the SAFE plan does is, let's say that on a monthly basis, your interest would be $100, right? Like you have the loan balance times your interest per year divided by 12, you have to pay $100 for interest every month. If your required payment under the SAFE plan is $0, then that interest, those $100 are not going to accumulate under the SAFE plan. The government is just going to write it off on a monthly basis, which is great because in the past, your loan balance would be increasing just because of the interest, even though you were eligible for a low or zero required payment. Now, let's say your required payment is $200 based on your income. $100 is going to cover the interest and the other $100 is going to apply to the rest of your loans. So under SAVE, it doesn't mean that you no longer pay interest. It just means that if your required payment doesn't cover interest, the government is not going to add it on to your loan balance. So at most, you're not going to see your loan balance increase, even if your required payment doesn't cover the interest. I hope that makes sense. But Nancy, I will give you the last 2 minutes to make that final question and point or any clarification.
I'm sorry, I was actually in the process of answering somebody's question, so I didn't really hear what you were saying.
No
or I didn't, but it's not that I didn't hear you. I just wasn't. I couldn't process both things at the same time.
Yeah.
So
I
yeah, go ahead.
The other question, so does working for CSS like a nonprofit qualify? Yes, there's actually an employer PSLF search tool. You can we can include it in the follow-up email that you get in a day or so with a PowerPoint. You can look up, you're going to need the employer identification number, the IRS EIN, and you will be able to put it in there and see if your employer qualifies for PSLF. So we'll provide that link.
So maybe I'm just going to answer live the question that I was in the process of typing. So somebody said that they just graduated from graduate school in July, and that they're getting an email about repayment starting in October, and that they enrolled and saved, but the payment still seems to be too high for them. So first of all, generally speaking, when you graduate, there is a 6-month period called the grace period, after which you still do not have to make a payment. But if you had Graduate Plus loans, you might go directly into repayment. Your SAVE plan should have been based on your income the last time you filed a tax return, or your current income if that's lower. If that payment is still too much for you, I think you should reach out to us for a one-on-one. The SAVE plan payments are generally pretty affordable for people in terms of what we're seeing. So maybe there's some kind of a glitch in terms of the way the application was, or the estimator that you used, but we've seen that before. So I'll reach out to us for a one-on-one, because I think we can help you with that. And I sense that we can probably find you an affordable plan.
Thank you. Reach out, like, don't hesitate. And if this is not the one, what is the best way for the one-on-one? Our contact information is there. I highly prefer email, because you send the email and you're going to be assigned a counselor. But if you call, we are doing our best to live answer every call we get. Obviously, if we get busy, you might be sent to voice message, but within a day or so, you'll get a call back. But I highly recommend the email. You're going to be getting a lot of notices, and it's going to be overwhelming. Hang on tight. It's going to resolve. You'll be fine. And again, feel free to reach to us at any point in your journey. We're happy to touch base with you and figure out a strategy. Again, thank you to everyone who has hosted us today. Senator Bernardes, Assembly Member Simon, the council members, we really appreciate your collaboration and spreading the word. We hope to be a resource now and in the future. And I thank you to my colleague Nancy for handling the behind the scenes Q&A. Really appreciate it.
Thank you, everyone. Have a great day.